Hi, everybody. This is Gary Dean, and this is our nightly video report for Wednesday, May 4th, 2016. We saw a continuation to the downside today. Actually, probably more neutral short term on the market because I do believe that we could get a bounce, and really the primary reason is we're nearing some support and we're starting to get some bullish divergences. So the way that this market's been doing is, they've been luring everybody in with a drift higher, then dropping it hard, getting everybody bearish, and then just bringing it back up and whipsawing people all around. And I think we're getting close to that time where we could see that bounce. I still think it's a little bit dangerous because it's I still believe that there's a lot more to go on the downside before everything is said and done. But I wouldn't be surprised to see some type of little rally or decent sized rally that could hit, or say bounce is probably a better word. So if we just look at our internals, I haven't really showed you these in a while, and you can see that the advanced decline line coming from levels we've never seen before, but yet the S&P wasn't didn't even get up to the highs, is rolling over now. If we just take a look at our the S&P and the VIX, this was at support, this is at resistance, it's been coming down, this is going up. This is one of the reasons why I think even though we could get that bounce that that I'm talking about, I just think it's dangerous because I still think that the VIX is going to go someplace here and the S&P is going to go someplace here before they make a decision. So if we take a look at the put-call ratio, here you can see that, the put-call ratio, you can see that it's heading up where people are starting to protect themselves with options. And finally, the bullish percent is rolling over. And again, this has been that little divergence that's been playing out. And finally, if we just kind of take a look, this is that fractal chart that I was showing you. And remembered where, we had a big drop, and then from there we made another move up, and it just came to the secondary high. So here's the secondary high, here's a strong move up, it came right up there. So if it's going to follow this, then what's going to happen is we should see this is the reflex rally that I'm talking about. That could be a couple days, but we're still most likely coming down into here. So it wouldn't surprise me to see the S&P drop somewhere to the 2040, then maybe have a quick move back up to the 2080, and then from there, that's when we start to see things really start to crater to the downside without any new highs being made. So let's take a look at our regular charts, and I'll show you why I'm kind of anticipating a bounce here. And first of all, we have the 50-day moving average that's at 2040. Typically that brings in some buyers, but it's also at support. So we're pretty close now. We're 11 points below it. Still plenty of room to go before we're oversold, and we have the bearish divergences. So even if we get this bounce, it's probably going to be just a bounce. We'll probably find sellers up at the 2084, but being this market takes the obvious resistance or support and breaks through it just to run stops and then reverse it, I wouldn't be surprised to see it go a little bit higher than that. But in any case, still plenty of room to go until we're oversold. And these bearish divergences, this move has not really fulfilled the length and time that this has been going on, and I still believe the ultimate targets are anywhere between the 1960 and the 1874. But if we take a look at the 60-minute chart here you can see that that's that support level. We have a fib retracement at 2040. We have the moving average at 2040, and we also have support. So this area, I think it's going to be pretty difficult for the bears to push through it on the first try, especially now that we're getting pretty oversold here, and we're also showing some bullish divergences. And this is actually a falling wedge, which is a bullish pattern, and one of the reasons why I think that once we make this low, you're going to see a slingshot type move somewhere back up here before we cradle back down again. Now, again, it's not guaranteed, so you don't want to be, going all in on the long side, expecting that bounce, because I've said this plenty of times that fear is much, much stronger than greed. So even though we have support levels, if they get taken out, then you get a reaction panic trade to the downside. So you want to be careful. Even though I'm saying I would expect some kind of bounce, it would make sense and fit the profile, it's obviously not guaranteed. So watch the 2040. Really, what the bears are going to want to defend are anywhere between the 2069 and that 2084. And if we look at the 15-minute chart, again, you can see bullish divergences, very overbought. And if it makes it up to, let's just say, a 50% or 78% retracement, we're looking at a counter trend bounce that's going to go up to the 2078, and it could go as high as 2097. So right now, I'd be really, really just careful adding new shorts. I think even just managing them with a stop, or just locking in some profits and waiting for a bounce to re-short is a good idea. Or, if you're aggressive, you can, try a long trade at 2040 on the S&P, see if it holds there. But like I said, it's just a little dangerous because, the fear is greater than greed. And, if we start taking out some important support levels, then, you could see some panic set in. So let's see what plays out tomorrow. Have a great night, and I'll talk to you guys in the morning.